We have a question from Keith, and Keith is saying, I have my investment split 30-70 between taxable and qualified, or qualified and non-qualified. Do you have any recommendations to which investments should be in each account? For example, should I buy stocks that pay dividends in the qualified accounts due to deferring taxes for the future, or in the taxable account? Thanks for all you do. So when possible, if you have different types of accounts, they have different tax treatment. If you have an IRA account, you are postponing your taxes, meaning that you get a tax break on the money that you put in now. So if you're in the 12% tax bracket, you don't have to pay the 12% on that income. You get to kick the can down the road to some future date. In my opinion, taxes are going to be higher in the future than what they are today. And if you're in the 12% tax bracket, I can't really see putting money into a pre-tax account unless, of course, you're doing it just to get the match. If you have a Roth account, as the law stands right now, that is one of the best accounts that you could have for tax purposes, because you don't get the tax break now, but you get the money out at some point in the future tax-free. Now, both those types of accounts are considered to be qualified accounts, because a qualified account is an account that qualifies for special tax treatment because the government said so. So the government made these laws to create the IRAs and Roth IRAs, and they control the tax treatment of those. I believe it's just a matter of time before they start running out of places to get money from, and they're going to have to mess with those rules. So it's a good thing to start balancing out and have some non-qualified money. So if you have these three types of accounts, I'll tell you the best investments, in my opinion, to own in each one. You want to own the lowest growth, highest income paying stocks in your traditional IRA account, because you have to remember that if you grow the money in an IRA account, you're not only growing it for you, but you're growing it for the government, because it's going to be taxed later, remember? You want to own the most aggressive parts of your portfolio in your Roth account, because you don't have to pay taxes on those gains as long as the rules stay the same. And then in the taxable account, or the non-qualified account, the things that I think that are best to own there. So you would be subject, if you do sell some things, you'll be subject to some capital gain taxes potentially. You also would have to pay taxes on any dividends or interest that you receive in that account. So the best things to own, in my opinion, things to start with there are going to be the ETFs, because they qualify for special tax, for better tax treatment than just an individual stock, meaning that especially in the enhanced strategy, they can go back and forth from the cash to the equity investments without passing that along to the shareholder. You also would want to own some of your foundational companies. That means that you are less likely to have to sell those and incur any kind of capital gains tax there in the future.